Inundated with too much information, unsure what the right car purchasing option is for you. That's exactly how I felt when in the process of buying my cars. In the last 8 years, I've owned 5 cars. And put it this way, I've learnt a lot the hard way. I've leased, I've financed, and I've paid for a car with cash. In today's video, we're going to be looking at those options in more detail, understanding what each one is, but also the circumstances of the buyer it most benefits. Mitchell here from Study Wealth, documenting our journey to success. In this video, we looked at how much car we can afford, and in this video, we're going to be looking at how you should pay for it. In 2019, the UK surpassed 40 million cars on the road for the first time. That's a lot of cars that a lot of people are buying, but how are they paying for it? I find there are so many ways to buy a car and so many opinions on which one is right for you and which one you have to do. Well, that's not what the purpose of today's video is. I'm going to be sharing the information and the circumstances that the people buying them use it for so that you can understand which bracket you fit into. It's important to note that I am not advising you which car purchase you should use, but make sure you stick around to the end of today's video because I've got the most popular buying method in the UK, one that needs way more explanation. So make sure you stick around for that, and please don't just fast forward to it because you need to understand the ones before it first. Car purchasing option number 1, and that is to pay with cash. Now, this is the simplest way to pay for your car, whereby you save an amount of money each month for a period of time until you have enough money to buy your car. Now, this is how I purchased my first car in 2012, a Vauxhall Corsa, my next car in 2013, another Vauxhall Corsa, and then my BMW 1 Series in 2015 that we're going to come on to more detail in a moment. Now, with each of these methods that we're going to be talking through today, there are benefits and costs to each of them. When it comes to paying with cash, the first benefit is that the interest works in your favour. You don't have it running against you because you aren't paying any interest on any debt that is accruing over time. Secondly, when it comes to paying for a car in cash, you don't have to worry about your credit history or your credit score because you aren't taking out a loan. Thirdly, and it's splitting up ownership into 2. Firstly, the fact that you own the car means that you can modify it in any way you want. It's completely yours. Secondly, by paying in cash and owning the car, you have the resale value at the end of it. Now, depreciation does have to be included as a cost to you here because your car loses value over time, but you still own the asset and you still get a resale value on it. Lastly, and the benefits of paying for cash is that the long-term numbers show that it saves you money. And we looked at how much car we can afford in my previous video, which showed that actually if you use the 10% allocation of car payments to instead put into a savings account and save, say for example, £200 a month for 4 years, you have £10,600 at the end to pay for your next car. So that is a great way, and in the long term numbers show that it saves you money. However, the negatives to paying with cash is that you are probably going to get, especially looking at the other methods today, the least car for your budget. This is because you are using everything that you have saved. Secondly, and this is looking at the opportunity cost of using your money and the time value of money. £1 today is worth more than £1 tomorrow due to a concept known as inflation. This means that if the debt you were to take out was going to cost less than inflation, your debt would actually be inflated away and become less amount that you'd need to pay back. Secondly, and this is the opportunity cost of using your savings, whereby your savings could actually outperform the cost of the debt if you were to keep it in an investment portfolio rather than spend it on the car, which is a depreciating asset. Look at an example here. If you were to take out £10,000 loan, which cost you 3%, it would cost over 4 years about £616. Now, if you were to say, for example, put that £10,000 in an investment portfolio that got you 4% return for 4 years, you would actually have £1,700 return over that period of time. Now, what that means is that actually you've got £1,000 just by taking out the loan, because it's cost you less than the return on the savings that you had. Now, obviously, this only works if you've got the savings ready to pay for the car. And of course, with investment, as we know, it's not a guaranteed return, but it's important to consider it as a cost, especially if you're getting an incredibly low interest loan. Finally, and when you're paying for cash, this is something you have to consider, especially if you're buying privately rather than main dealer where you get extra warranty, is that you are fully responsible for the car. Now, I learnt my lesson here, as I mentioned, I'd come onto it later with my BMW 1 Series, whereby I actually bought it and 2 months later the engine completely went and cost me £2,500 of a £5,000 car. It cost me 50% of its actual value within 2 months. So it's really important to consider that because you're getting less car for your budget, the repair costs could be higher and it could end up just costing you more money anyway. So those are the benefits and costs of using cash. I just want to quickly summarize that. Simplicity. It is the simplest way to buy your car and you're using your money, your savings. It's lower cost, especially over the long term when you don't have car payments and you don't have interest. The last two, however, are that you have the repair responsibility, which I learned a lesson with on my BMW, as we know. And finally, you're going to get less car for your budget. Car purchasing option number 2, and that is to pay with cash, but to use a personal bank loan. Now, this is a way to spread the cost over a period of time. However, it's very much aligned with how we pay with cash above, whereby you have full responsibility of the car, you own it from the very beginning, and you get the resale value. The first main difference with paying with a bank loan is that you have to have your credit history and credit score checked. And it's often the case that the better your credit score, the lower the interest rate on the loan. So this is something that's very different to the paying with cash because you aren't taking out any loans and so you aren't paying any interest. Another one is that, of course, with this way, the opportunity cost works in the opposite direction. And so if you're, say, for example, the guaranteed investment savings are less than the cost of the debt, then it may be better to pay with the savings rather than get out the debt. But it's important to get competitive rates here and to make sure that you shop around so that the APR, the annual percentage rate you're getting, is competitive. As you are a cash buyer, you do actually have less negotiation power with a personal bank loan than using a main dealer's loaning arrangements. However, like I mentioned, make sure that you're getting competitive rates for that personal bank loan because it can save you money in the long run because you haven't got arrangement fees or option purchasing fees that, again, we're going to come on to later in more detail. Finally, with this car purchasing option, like I mentioned, you're spreading the cost over a period of time. Thereby, you could use your savings to actually get more car for your money by, saying, putting a big deposit down and financing the rest using the personal bank loan at a competitive interest rate. And that's a big characteristic here that sometimes sways people from just using their cash and instead using their cash as a deposit and leveraging themselves using a personal bank loan because they can get more car that requires less repair needs and can end up saving them because it depreciates less. So when they sell it, it holds its value more. The last 2 points that I want to mention here are characteristics and some things that you need to be aware of. Firstly, it's to make sure that you do not secure the loan against your property. I'm not sure if you've seen Can't Pay, We'll Take It Away, but I definitely don't want to see you on there. Secondly, it's important to understand that with this method, there are higher monthly repayment costs, basically because at the end of the loan term, you would have paid for the entire car. I want to summarize, paying for a car with cash using a bank loan is cost spreading. So as your cost spreading, it's possible to get more car for your money, but also it costs you in monthly installments. Yes, you pay interest on it, but you don't pay an amount of money up front if you don't necessarily have that amount to put down. Secondly, it's yours. Now, this is important because of the later purchasing methods that we're going to go through. You own it from the very beginning because in a sense, you are a cash buyer. The last two are credit score. This is the first one where your credit score is quite a big factor here because you get more competitive rates the better your credit score is. And lastly, unsecure it. I really don't want to see you on Can't Pay or Take It Away. Car purchasing option number 3, and this is known as a hire purchase agreement. Now, this is very similar to the personal bank loan, whereby you are cost spreading over a certain period of time, and by the end of the agreement, you would have paid back for the entire car. You put a deposit down and you pay the monthly payments to own the entire car. So the monthly payments are almost about the same level when it comes to a personal bank loan. However, the main difference here is that you don't own the car until the very end, and you have to pay an option to purchase fee. Now, these fees start creeping in when it comes to the main dealers. This means you can't make modifications and you have slightly more restrictions on what you can do with the car because you don't own it until the end. I would always, and I recommend comparing directly, a personal bank loan with a HP agreement, a hire purchase agreement. Look at the total sums you pay back for each, because the hire purchase sometimes has fees that are neglected when it comes to actually understanding how much it's going to cost you. Do not just look at the interest rate, because what some main dealers do to really compete with the personal loan banks is to offer 0% financing. Now, this is often compensated for an inflated sale price. As I mentioned here, they are making their money somehow. So 0% financing does sometimes sound to some people too good to be true, but they're getting their cost somewhere, whether that's the fees or whether that is an inflated cost price. So always be careful when getting drawn into, oh my God, I've got a free loan here, I must go for this, because you may actually be able to get a cheaper car by not doing that. Now, for both a hire purchase agreement and a personal bank loan, the monthly repayments are higher because you're paying for the entire car. And I may put a quick visual here on what I mean by that. Because you're paying for the entire car, at the end of that term that you've paid, you therefore have higher monthly payments. Now, the way to reduce this significantly is to put more deposit down at the start and then finance the rest. That's the way that you can get the most amount of car for your budget. The way I would summarize a HP agreement is, again, cost spreading, because you are not paying as much up front, you're spreading that cost over a period of time. Secondly, it's not yours. You don't own it until the end of the agreement once you've paid that optional purchase fee. That's why I've also considered fees in this summary, something you really have to be careful of when you're dealing with these main dealers. Lastly, and that's negotiation. With a hire purchase agreement, there is sometimes more flexibility and more, shall we say, negotiation that you can have on getting the best deal for you, because you are using the main dealer's financing company, and so they sometimes give you deposit contributions or 0% financing. Always be aware of these, and again, look at the total sum value, check the market value of the car, but that is the summary there of a HP agreement. If I move on to the final two purchasing options when it comes to buying a car, if you're getting value from this video, please click that like button and subscribe to my channel. It takes a long time to create these videos, and in particular this one, where I wanted to make sure that I covered everything in detail. So please make sure that you are liking and subscribing, and of course just supporting me by commenting below your favorite purchasing method and also some of your opinions. I would really appreciate just having a bit of conversation in that comments section. So let's now move on to car purchasing option number 4, the second to last one, just before we move on to the most popular one in the UK. I wonder if you know which one that is. I'll give you a bit of a secret. It begins with P, and we'll be there just after the penultimate option. The penultimate car purchasing option, option number 4, is known as personal contract hire, and it's moving towards the concept of leasing, which is another word for, in a sense, renting. It's calculated by looking at the difference between the sale price and the expected depreciation over a period of time. They are your monthly costs, obviously with an interest rate on that as well. You pay 2 to 3 months up front as a deposit, and then the rest of the monthly repayments, usually for about 2 to 3 years. After that period of time, you hand the keys back, and you most likely go into another PCH agreement. As I mentioned, a really simple way to look at this is that you are basically financing the depreciation and you're renting it from them. They're saying to you, okay, we expect that it's going to cost 8 years for you to, it's going to cost £8,000 for you to drive this car for this period of time. Therefore, we're going to charge you £8,000 divided by 36 months or 24 months, depending on your period of lease. And you pay that for that period of time. Now, as with all of these options, there are benefits and negatives to this that we're going to look at now. I leased my Mercedes in 2015 after having that awful experience with my BMW 1 Series. The reason why I did it is because that I had lower monthly payments. It required less deposit. I think it was around 3 months of the monthly payments. It's between 3 to 6 usually. I had the manufacturer's warranty on it, so I didn't actually have to worry about something like the BMW happening to me again, and also I had road tax and a couple of maintenance and servicing costs included in that. Overall, I think when I look back at it now, I saw it as an opportunity to drive a car that I wouldn't usually be able to afford as an outright payment. Now, the reason I did that is mainly because of, I suppose, how easy it was and how it didn't require me to sort of have to worry about repair costs and fixing costs. It was basically the most affordable way for me to get into that expensive car. And another thing to note here that is less relevant to my experience, but it is something to note, is that the leasing companies do have quite a bit of buying power and sometimes get economies of scale because of the amount of cars they buy. And that is sometimes reflected into how much it can cost you to pay monthly. It's definitely something to consider if you're looking to get into a newer, more expensive car that you sometimes wouldn't be able to afford. This is a way to do it because you're just renting the depreciation. However, just like all of these options, there are negatives to it. Firstly, you aren't getting any resale value. You're just financing the depreciation. You never actually own it. Secondly, there are strict wear and tear policies. I remember late into the night, the day before handing back day, I was really waxing that car just till the early hours, worrying about what the wear and tear policy would say and those potential extra charges. And a little bit of a, just breaking off here, a bit of a funny story, going into the monkeys sort of enclosure in Longleat, and the monkeys decided to pull off almost like the sort of plastic ribbon going along all the way the car, literally pulled it off. Luckily we were honking the horn, but it still did some damage to the car and you have to pay for those repairs also. Another thing, and a big negative, is that you have allocated miles. This really, really hurt me because my circumstances changed where I was traveling back and into university on a weekly basis, which meant my mileage costs at the end of the term nearly cost me £1,000 extra because I had an allocation of 6,000 miles, but I was doing about 12,000 miles a year. So I was doubling that. And as soon as you go over it, you start paying between 6 to 7p per mile over. So if you don't stick with the standard leasing options, it can become more expensive. For example, not going for the standard color means you pay a premium price, a premium cost, or a premium extra charge for black, say for example, rather than going for the normal option of white. So that is also something to consider. If you are leasing a car, you do have extra charges as soon as you want to change anything from the standard package. Lastly, and it's to do with the credit check. Again, you are credit checked against this deal because you're taking out a loan, you're financing, leasing that depreciation. And so also interest rates are often higher than say on a bank loan or a HP loan. So you also have to be careful with that. So the way I would summarize personal contract hire is basically new car often. That's the first part here, is that you're able to get into a car you wouldn't normally be able to afford because you are just financing the difference between its current value and its residual value at the end. Secondly, it's never yours. You're renting. You're not going to own it. Thirdly, restrictions, because you've got allocated miles that you're allowed and you've got a strict wear and tear policy. You have to use the standard car. So that's the main point there when it comes to restrictions. And finally, it's more costly because you're getting a newer car that you often won't be able to afford. That depreciation curve, you're actually basically financing its steepest part, the steepest fall in its depreciation. Hoping you're finding this video useful so far. Before we move on to the next final, most popular purchasing option, I just want to say, go back and look at my summaries if you need to understand in a little bit more detail. Again, I know it's a lot of information today, but it doesn't get any easier now, unfortunately. The final and most popular one is, of course, the most complex product also. It is known as Personal Contract Purchase, PCP. PCP is the most popular purchasing option in the UK, with 80% of new car buyers using it. In 2017, that was £40 billion of the car buying market. It's a lot of money and it's complicated to understand it, but I'm going to try and break it down for you today. It's the best way to represent PCP is in a graphical format, which I'm going to do here. It's basically split into three main sections. You pay for the deposit, you then pay for the deposit between the amount you've paid on the deposit and the residual value, which is also known as the guaranteed future minimum value. And then you have something at the end called an optional payment or a balloon payment that you pay. I'm just going to put here a diagram of a car that really simply breaks down those three segments. Now, the deposit is obviously coming from savings or deposit contribution. The middle value is what's financed, and that's where it becomes quite similar to leasing. So the first part is obviously kind of your normal, either you buying with cash or your HP agreement. You've got the deposit down, bank loan, all of them, deposit. Then you've got the residual value and the difference between that and minus the deposit of the cost price. That part there is very similar to leasing. And then the optional payment, the balloon payment at the end, means you then own the car. So that's the three sections that PCP splits into. You have to ask yourself why so many people use it. There must be benefits to it. And the first one mainly is its flexibility. By splitting into three sections and it being a complex product, you are actually able to have a few decisions at the end. You can simply give the keys back, similar to a leasing agreement. You finance the difference after the deposit between that and its residual guaranteed future minimum value, and therefore you can just hand the keys back and not do anything with it. You can pay for the balloon payment at the end and actually own the car, or finally, you can actually go into another PCP agreement just by you literally finishing up with that one, not paying anything and going into another one. And I'm going to come on to a little bit later on something you can use in that new agreement. Secondly, and you have market security. Now this is key here because, and I'm doing it using an example for it, using the £1 petrol cars. So let's say we're driving for the next 3 years, you buy a petrol car on PCP, and petrol cars are completely banned in London. It's completely banned anywhere around the M25. And your price of a petrol car falls to £1. You are protected there due to the guaranteed future minimum value being pre-agreed at the start of your deal. What that means is that you are not going to have to finance the £1 to the deposit amount. You're just financing the already agreed amount between the residual value and the deposit. And what that means is that you simply at the end of the agreement can hand the keys back and not have to count your losses. You are secure from that market volatility. Another thing to consider here is that you probably can get the most car for your budget because you're only financing the difference between its residual value. It's very similar to a leasing agreement where you can get a newer car that you probably usually wouldn't be able to afford. Now, it's really important to note here that it's the way to get the newest car for your budget if you are not considering owning the car at the end, because otherwise you're going to be paying interest on top of interest because you're going to have to finance that balloon payment at the end of the agreement. Because in the current agreement with PCP, you are paying the interest on the entire loan and not just its difference between the deposit and the residual value. The last two benefits of looking at a PCP deal, and we're going to look at the negatives as to why this reason is, but it is the favorite option for the main dealers. Now, what this usually means is that the negotiation power on a PCP agreement has gone up when compared to cash buys. So this means you can get deposit contributions, or you can get servicing or maintenance costs included in your deal. You overall have more leeway to really negotiate with the main dealers. Lastly, another reason why it's so popular is because of the simplicity of having one monthly car payment cost that includes the cost of the car, it includes the cost of servicing, maintenance. You literally just pay one fee and everything is covered. You are driving your car simply, and that sometimes is attractive to pay the premium for it and to have that flexibility. So now we've got flexibility, market volatility, you can get more car for your budget. You then also can have sort of more negotiation power with the main dealers because you can get bigger discounts as they want to give you. We're going to come on to the negative reasons why, but they want to give you a PCP loan. So you get deposit contributions, servicing packages included. It can be a way better negotiation. You can get more off on your deal. Another reason is its simplicity. Some people are happy to pay a bit of a premium to pay one fee, have their servicing, maintenance and car costs all included, and it's all there. It's all very easy. Finally, and I'm going to use this last benefit to bridge it on to our negative. It is the concept of equity, which I sometimes see referred to as free money when it comes to a PCP deal, and that couldn't be more wrong. And I'm going to show you as to reason why. A popular reason as to why PCP is used is because at the end of the term, it is set up so that you have positive equity in your car. Now, what positive equity means is that the value of your car is worth more than the guaranteed future minimum value. Let's say, for example, it is worth £12,000 at the end of the term rather than £10,000, which is what was agreed. You actually have £2,000 equity in your car. Now, where people get confused in thinking this is free money is that actually your car has depreciated less than what has been put in your payment plan. So let's say, for example, it's agreed that you've got a £20,000 car and that it's going to be worth £10,000 in 4 years' time. Over those 4 years, you've paid a monthly fee that accounts for a £10,000 fall in value. So you've paid £10,000. I'm not going to account for interest or anything here, just to keep it simple. So you've paid £10,000 in those 4 years. However, by the end of the agreement, you actually only should have paid £8,000 in total because the car's only fallen by that amount, not 10. And so you've got £2,000 there. You overpaid £2,000 that they're then allowing you to put towards the next PCP agreement. That money hasn't come from anywhere. You've paid it, but you can use it on the next PCP agreement with main dealers. Now, another really important benefit is that you can use that with multiple main dealers. The wrong thing here is that people think you have to use your current dealer. No, other manufacturers will do all of that for you in terms of buying the car at the pre-agreed 10,000 and selling it for its current value of 12. They will do that all for you, and you can go into another PCP deal. Now, where I'm going to bridge it with negative points is looking at negative equity. Now, when it comes to buying a PCP deal, there may be at times some reasons writing it off. It's stolen. You need to, for example, you can't afford the monthly payments anymore. You need to hand the keys back in, whereby the depreciation has fallen at a faster rate than what you've currently paid off. So let's say, for example, the car has fallen in its first year £5,000. It's now worth £15,000. But this is a faster rate at the start than what you have actually paid. You've only paid back £3,000. That means you're in a £2,000 negative equity. There are things that you can do to cover that, but basically what it means is that the car's current value doesn't cover the cost of your debt. So actually, you'd still owe the finance company money even if you were to sell the car at that point in time. Now, PCP deals are set up so that at the end of the term, this comes back round so that you do have positive equity. But negative equity is a really important thing to consider because it might have to be refinanced and you have to pay interest on it. It goes into your next deal so you can afford less car, for example. Negative equity can really sort of hurt, in a way, the need to hand it back early. If you had a car crash, wrote it off, you then need to find £2,000 somewhere, and that's where further costs come into it, such as gap protection, which costs you money to make sure that you're protected if the car's depreciated more than what you've paid off. There are a couple of other ways, such as voluntary termination, where if you've paid 50% of the overall car, which you're probably not going to do it till the end of the deal anyway, but if you have, then you can just hand back the keys if you've paid back 50%. Sometimes it's not favourable to get new APR rates if you are continually doing this, so it's not advised, and it's also sometimes quite difficult for people to pay 50% off of a deal where they're trying to get the most amount of car for it. They can't sometimes actually afford that deal at the end. So finally, when we're looking at equity, now equity is a really broad topic, and I know I've covered a lot of detail here. I'm hoping you're still with me. At the end of the term, you don't have any equity in your car. You are going to have to find a deposit from somewhere else. They are set up to have, but they may not, because the car may depreciate below that value due to market factors, for example. So you then have to find a deposit elsewhere to go into another agreement. The negatives when it comes to looking at it, I've called it the dealer's dream. And this is because with a PCP deal, you often don't buy. You hand the car back in very good condition to avoid damages, charges, which then means that they can then resell that, financing it again. It makes the cars more affordable for more customers, and you often stay and use your equity with the current manufacturer. You don't go shopping elsewhere. If someone calls you up from a main dealer and says, you've got equity in your car, would you like to use it? We're going to give you £5,000 to your next car. Oh, that sounds great, free money. That's not the case, and I'm hoping now you understand that, but it's a dealer's dream. Other negatives in addition to the dealer's dream is that you basically need to be credit checked again, like with the other financing agreements, to get the best APR rate. You're only going to do that if you have a very good credit score. As I mentioned a little bit, and I touched on it earlier, if you don't make the balloon payment at the end and you can't afford to, then you're going to have to finance that and again pay even more interest on financing that balloon payment. And again, that is if you want to own the vehicle at the end of it. Moving on to ownership, you never own the vehicle unless you make that balloon payment. That restricts you on modifications. It's not yours. Another negative, fees. Fees if you damage the car, fees on wear and tear of the car, arrangement fees of the PCP deal. What other fees are there? Optional payment fee if you want to actually buy the car at the end of it, which can be up to £500. Fees, 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 all hidden fees that can catch up with you if you don't look at the total sum value at the end. In addition to fees, you've got restrictions, allotted mileage, and it can be pricey if you go above that 6 to 7p per mile if you exceed the allowance. So you have restrictions. It's not yours, you don't own it, and you can only do certain things with it. Drive it a certain amount of distance, for example. Finally, and on the negative side of things, if you aren't looking to actually own the car, then it can be the most expensive way to just lease. Yes, you are having flexibility with your options, but you, in a sense, due to the buying power of leases and how they can make your monthly costs lower, sometimes it can be better off leasing if you're not worried about the ownership. Because equity, please remember this, I'm going to keep drilling it down, equity has nothing to do with free money. It's money you've paid on the depreciation that's over depreciated. It sounds so complicated, but it's just your payments are more than what the car has actually fallen. To summarize PCP in the same way as I've been doing for the others, you can get more car for your budget. It's a good way, because of that balloon payment and the way it's split up, which you'll see here, it's a really, really easy way to get into a more expensive car that you wouldn't normally be able to afford. It's not yours, but it could be. You have that flexibility to make that payment at the end if you do want to own it. Therefore, it's also with flexibility, it's more simple. You can pay a one amount of money that has maintenance, service, all included in it for you. You pay a bit of a premium for it, but you get that simplicity. Finally, it's looking at the last three: deals, equity, and costly. And I've listed those three very briefly here. Deals is because you have negotiation power, because it's the dealer's dream. Equity, I've explained that in enough detail here, but you have positive and you have negative equity. And again, costly. And as we know, what we mean there is that you are paying a premium to have the benefits of flexibility, market volatility, all of the getting more car than you can afford, normally lower monthly repayments, all of those things, servicing, maintenance included, all those things come at a little bit of a cost. Please put in the comment section below your financing agreement that you've used or that you're looking to use. I'm also going to open myself up to taking any calls on this topic. It's something I'm very passionate about and also something I'm very experienced in. If you would like to have a call with me on your car financing options, I'm more than happy to do so. So just comment in the section below, call me, and I'll be in touch with you on that, on further details. I'm really hoping you're enjoying these videos. Thanks again for listening to the very short series on car ownership.